lecture, I will be discussing, as I told in this video lecture, I will be discussing about business valuation. Business valuation. So let me ask you, can business valuation be tested in session C? Yes or no?
No.
Yes.
No, who said yes here?
So that P by ratio.
No, not the P bar E ratio. Business valuation topic cannot be tested in session C. No questions you can expect from business valuation. You can expect a question from business valuation in session B. In session B, there are 3 questions, right? In section B, there are 3 questions. One question will be from business valuation for sure, 10-mark question. And the second question will be from risk management for sure. Okay. Third question can be from business finance or from working capital. Okay. So there will be 3 questions from section B, and 1 question can be from business valuation. So let me ask you, how much marks can you expect from business valuation? I mean the weightage, not your marks. I'm asking about the weightage. How much mark?
14.
Okay, 10 to minimum of 10 marks. There will be a question in section B. So you can expect 10-mark question for sure. And maximum of 16 marks. So 10 to 16, anywhere between 10 to 16, you can expect. Minimum of 10, maximum of 16. If a question, there can be questions in session A also, you can expect 3 MCQ questions, maximum of 3 MCQ questions in section A also from business valuation. Okay, so that is that. That is what business valuation is. Okay, so what do you mean by the term valuation? What do you mean by the term valuation? What do you mean by the term valuation?
Evaluate.
Evaluate. We are valuing the shares or the debt, everything. We are valuing a company, right? Here we are valuing. Could you please tell me what are the situations in which we have to value something, value a company?
Merger, acquisition.
Yeah, at the time of mergers. Could you please wait. Could you please I'm asking to Indians. Could you please tell me a merging, an example for merging, 2 companies merging to 1? Could you please tell me a merger, a famous merger in telecom industry?
Sir, VI.
VI,
Idea
very good.
and
VI
Vodafone.
and Idea, those companies were merged. It's become VI. Vodafone and Idea merged. Excellent. Okay, that was the example I was trying to get from you. Okay, it was a
Intel
merging.
and Airtel also too.
Yeah, those were a few years back, I think. The latest one I would say VI. We also few years, but Airtel and Aircel was in maybe around 10 to 12 years. Okay, anyway, takeovers, mergers, acquisition, and for tax purposes, everything we have to value a company, right? We have to value. We have to find the market value of a company. So valuation is in the valuer's eyes. I would say in the valuer's eyes. Value of a company is in the valuer's eyes. If I can value something, and if you're gonna value, you will get a different value. Different value. It's in the valuer's eyes. Okay, you cannot say that everyone will find same value for the same thing. Okay, if you are, let's take an example of cricket. If you're a hardcore cricket fan, and if someone gives you an autograph, some signed cricket bat, then if you're an hardcore fan, then you will value more, right? So valuation is in the valuer's eyes. So if any method, you can use different method for valuation. Whatever method you are using, you will get different values. Don't expect the values to be value of a company to be same using different method. Okay, so that is what business valuation is. So in this lecture, sorry, in this area, business valuation, there are few topics you need to study. Few topics you need to study. So let me tell you, you have to learn few things here. Few things here. Let me tell you. First of all, equity valuation methods. Can you see the screen?
Yes,
Can
sir.
you see the screen? Okay.
Yes.
Okay. Equity valuation method. So you are valuing the shares of a company. You are valuing the shares of a company, equity shares. You are also going to value preference shares. You will be also going to value debt of a company. Now I'm telling about equity shares. Equity shares can be valued in 3 different approaches. What are the approaches? 3 different approaches for valuing equity of a company.
Differentiates.
No. I'm asking about equity valuation methods. 3 approaches for valuing shares of a company.
Gordon Group method.
No, I'm asking about valuing the shares of a company. You're telling whatever you're telling us, right? No. 3 methods, I would say.
Price or ratio.
Wait.
Asset-based, income-based.
Yeah, excellent, Yusuf. Asset-based
Cash flow
methods,
based.
income-based methods, and cash flow-based methods, right? Okay, those are the 3 approaches in which we can value a company. We can find the market value of equity shares of a company. So in asset-based methods, asset-based methods are further classified into 3 methods. There are 3 methods in asset-based approach. Which are they? For valuing the asset, there are 3 methods.
Net asset value.
NRV method.
Replacement.
Yeah. First of all, book value. Book value. You can value net assets by calculating its book value. You can value net assets by calculating its NRV, net realizable value. You can calculate net assets by calculating the replacement value.
Cost.
Okay, there are 3 asset-based methods, right? Income-based method also. There are 2 income-based methods. Which are they? Income means profit, earnings. I would
P
say.
by ratio method.
P by E ratio. Okay,
Earnings
PE
yield.
ratio method. Yeah, earnings yield method. Okay. EY method, earnings yield method, and PE ratio method. Those are the income-based methods you have to see. And in cash flow-based methods, there are 2 things, but fortunately, you have to study only 1 method for financial management. Okay, you do have dividend valuation model or is constant growth model. You do have DVM and also
CFM.
Not CFM. CFM is not calculating K. We are calculating market value. So you do have free cash flow method.
These.
Okay, or else free cash flow method, I would say. Okay, so since free cash flow method cannot be tested in your financial management, you can expect only dividend valuation method. Okay, we do have dividend valuation method for calculating KE also. KE equal to D0 into 1 plus G divided by T0 all plus G. That was the equation to calculate KE. And there is another equation to calculate P0. Here we are calculating market value of one share, right? Okay. Anyway, I will be discussing about all these things. Okay, wait. So before entering into debt valuation, the next topic you have to learn is debt valuation. You have to value the debts in a company. You cannot find the market value of bank loans. Why do we cannot find the market value of bank loans? What's the reason? Because bank loans are
Market value is not there.
okay. Bank loans are non-tradable, right?
Okay.
Bank loans cannot be traded, so it doesn't have market value. Its nominal value itself is the market value. Okay, so we will be calculating market value of loan note only, not bank loans. We'll be calculating market value of loan note, or else I would say bonds. Okay, there are 3 types of bonds. Which are the 3 types of bonds?
Redeemable, irredeemable.
Convertible.
Redeemable, irredeemable, convertible, right? Redeemable. Okay, I would say irredeemable first. I would write irredeemable first. Irredeemable, which means we cannot redeem. The issuing company cannot redeem, is irredeemable. Then redeemable. One more.
Convertible.
Convertible. Is convertible redeemable or irredeemable? Convertible are redeemable ones, right? They can redeem into shares. Okay, they can give back that bond and collect the shares, right? So there are 3 types of loan notes: irredeemable, redeemable, and convertible. In these 3 cases, we have to find market value of loan note. Okay, both redeemable method and redeemable loan note and convertible loan note, you have to find. You will be finding market value of the loan note by using present value of future cash flow. What? Present value of future cash flows on those bonds. Okay, on those loan notes. That's how you will be calculating the market value of both redeemable loan note and convertible loan note. If it is irredeemable, there is an equation. There is an equation where P0 equal to I by KD. You can simply divide the interest by cost of debt. Interest by cost of debt. You will get the P0. P0 means market value of loan note if it is irredeemable, right? If it is irredeemable. Okay. So you also have to find market value of what? Preference shares. Preference shares market value will be P0 equal to D by KP. KP means cost of preference shares. Okay. P0 market value of preference shares equals D by KP, right? This is the market value of preference shares. Okay. Anyway, let's tell about efficient market hypothesis. Okay. A company in a stock market, there are different type of efficiency. There are operational efficiency, there are transaction efficiency, and there are information processing efficiency of a stock market. Based on the information processing efficiency of a stock market, a stock market are divided into 3. Which are they? Based
Weak
on
form stock.
Yeah, it's weak form stock market, semi-strong form, and also strong form, right? And also strong form. So there are 3 forms of stock market based on the information processing efficiency. What do you mean by the term information processing efficiency? So an information about a company should be incorporated into the share value, right? Information. Suppose Steve Jobs was, I think Steve Jobs died in 2012. Immediately when the news came out, Apple shares went down, right? So that news about Steve Jobs should have to be incorporated into what? Apple share price, right? That's how stock market, we can say how efficient is the stock market. So in terms of processing information about a company, stock market is divided into 3 forms: weak form, semi-strong form, and also
Strong form.
strong form. So let me ask you, suppose your stock market is a weak form efficient stock market, then the value of your shares are reflected like the shares value are like those information which came from the past. Let me tell you an example. Suppose an information came today, but the share price has to change immediately, but the share price is changing after 1 month. Okay, that is weak form. Okay, let me ask you, what will be the form when immediately the share price is changing? If an information came and the share price is changing immediately, then what will be the form? Is it weak, semi-strong, or strong? It has to be semi-strong.
Semi-strong.
All stock market, Bombay stock market, London stock market, and New York stock exchange, every stock exchange is semi-strong only. We cannot achieve strong form. Okay, because strong form is something like before announcing the news to the public, the stock price is changing. Immediately after Steve Jobs' death, it's not public, the news is not public yet, but Apple share price is changing. Okay, that is what strong form is. It cannot happen. Only share price will change when the news comes out. Before the news comes out, before the announcement, no, share price cannot change. Okay, so up to till 2025, all stock market could achieve only semi-strong efficient. Strong form efficient cannot be achieved. Okay, so weak form, semi-strong form, strong form. Now let me ask you one question. A news came out today at 5 p.m. Okay, 6 p.m. the stock exchange closed. At 6 p.m. the stock exchange closed, and the next day morning itself, the price of a company, the price of shares changed. So what form itself? What form is the stock market? Just let me ask you one more. 5 o'clock, a news came about a company. 6 o'clock, the share market closed, and the next day only the share price changed. So what form is the stock market? Is it weak, semi-strong, strong?
Weak.
It's weak only, because if it was semi-strong, it has to change immediately, right? It cannot go tomorrow to change. Okay, it will change immediately. If it was weak form, if it was strong form before the announcement, before the news itself, it would have changed. Okay, it's changing tomorrow, which means it's weak. It's not changing immediately.
That's it.
It's the share price are
That's
reflected on the past data. Yesterday's data, it's past now. The share price is changing based on the past data. That is what weak form is. Share price is
Because
changing
of-
based on the past data. Okay, if it was semi-strong, immediately at 5 p.m. it will change. Immediately at 5 p.m. it will change, right? If it was semi-strong. If it was strong form, it would have changed it when before the news came out. Before the news came out. Okay. So that is what weak form, semi-strong form, strong form, right? Okay. Let me ask you one more question. I went to a company. Okay, I was suppose I'm a spy. I went to a company and I secretly watched their general meeting, and I got few information, and immediately the share price changed. Immediately when their general meeting was going on, it was a secret meeting. Immediately when their meeting was going on, the share price changed. So what form is that?
Semi-strong.
Strong form.
It's strong form. Okay, they haven't announced it to the public, but immediately when the meeting was going on, the share price, they are making decisions in the meeting only, the share price is changing. That is strong form. Okay, that is strong form only. You cannot
But
expect.
insider dealing.
Yeah, it's called insider dealing. That is what called insider dealing. Okay, if you can, but insider dealing is punishable, right? So strong form cannot be achieved. Strong form is a myth only. It cannot be achieved. Only we can achieve up to semi-strong form, right? Okay. So there is no weak form also. Every stock market should be semi-strong form, right? So in India, I think the most of you are Indian. So say in India, could you please tell me any announcement which made the share price up or down? Any announcement? Those Corona days, I will give you an example. Those Corona days, Facebook has invested in Reliance company, right? Facebook has invested in Mukesh Ambani's Reliance company, 10% investment, I think. So immediately the share price went up. Reliance company's share price went up, right? So that is an example of semi-strong form. When they announced an investment, that time itself the share price was going up. Okay, that is what called semi-strong stock market is. Normally our stock markets are semi-strong, right? Okay. So let me ask you a question. In weak form efficient, the share price will change on the information that the company announced 1 month before. Is the statement true or false?
False.
False. Why? Because there is no time. It's not time. Only time that state is that immediately. In semi-strong, share price has to change immediately. If it is weak form, it's about past data. It can be yesterday's. It can be 1 month. It can be 1 year. It can be many years. Okay. There is no time. There is only, they are saying it's past data. Okay. It can be, there is no time. It's not 1 month. It's not 2 months. Anywhere if the share price is still reflecting any past data, it can be what? Weak form only, right? Okay. So let me ask you one more question. Can we make gain in strong form market?
No.
No. Why? Because
No capital. There is
no,
no movement.
movement will be there, but immediately when they're discussing something, before announcing, they're discussing something, they're planning something, immediately the share price is going to change. So how can we get the what? How can we get a gain in strong form market? No, it's nearly impossible. By insider information, we cannot get a gain. Okay, we cannot always make gains, because immediately when they are taking a decision, that time itself the share price is going to change, right? So that is what weak form, semi-strong form, and strong form market. Okay, then let's discuss about behavioral finance. What do you mean by the term behavioral finance?